Hi everybody, this is Phil Holoka from Complete Captive Management Services. Today we're talking about where does collateral go? I hate to chuckle a little bit, but this is a very technical conversation. So I wouldn't be surprised if you had to revisit this topic if it didn't make sense on the first pass. So to fully talk about this, we've got to silo three different people: the employer, the captive, and the carrier. So in this example, the employer enters into an engagement with a captive that is fronted. And let's just call this a group captive. Remember, the captive is a non-admitted carrier. Okay? The carrier who issues the policy is an admitted carrier. So the flow is the carrier will issue the policy to the employer. And in exchange for that policy, the employer is going to pay the carrier. Now let's pretend that the policy premium is $100. Therefore, $100 expenses from the employer flows to the carrier. Now, the next step is the collateral calculation is handled at the carrier level. So the collateral calculation determines how much additional collateral needs to be collected from the captive, not the employer yet, but from the captive. Therefore, $17 is demanded from the captive. Now, the captive has a deficit. It has a $17 deficit. So to correct that deficit, it needs to submit an invoice or a bill to the employer. Now, there are two options here. If the captive remits a bill to the employer for just the collateral, $17, the employer is going to cost that $17, and that $17 will flow directly to the carrier. This could be a letter of credit, this could be cash. Okay? The other option, if the captive is mutually owned by the employer and there's a membership agreement or some sort of ownership there, the captive may bill the employer $20. Therefore, $20 is a cost to the employer. That $20 will flow to the captive, leaving $3 of surplus. Because after the carrier or the employer pays $20, that's going to make the captive whole. So the $3 in leftovers is surplus, which is expressed on the balance sheet of the captive. Okay? Now, where's the $17 coming from? Well, that is dependent on a lot of things, but it's really driven from the reserve calculation, which is done by the carrier's actuary or actuarial team. Okay? So, the annual statement is a required submission to the regulator. Even the captive submits an annual statement. And within that annual statement, there is Schedule F, as in Frank. That Schedule F expresses how many dollars have been collected and how many dollars represent reinsurance dollars. Because remember, the captive is reinsuring the carrier. So, the carrier not only collects premium from the employer, but they also sell other policies. And let's pretend that there's $1,000 worth of other policies. Well, if the employer didn't have Schedule F, they would report to the regulator $1,100 worth of premium collected. That's not correct. What is correct is $1,000, because $1,000 has been collected from policies that the carrier issued, and $100 are reinsurance policies. Therefore, you've got to back out the reinsurance premiums collected, leaving $1,000, because when the carrier issues $1,000 worth of policies, that $1,000 has to be backed by securitization or collateral for the carrier, because what happens if they sell $1,000 but have $1,200, $1,300 worth of claims? Where's that other money coming from? The surplus. Okay? So, pretty deep topic. Next week, we're going to talk about this. The employer is really paying $117 or $120. How do they account for that? Another awesome topic. So until then, talk to you soon. Bye now.